Tony Morris, head of interest rate research at ANZ Bank, joins us now live from Sydney. Tony, hello. Thanks for joining us today. Well, I suppose the Australian Central Bank has taken many by surprise, hasn't it?
They certainly have. If you think of the depth of the European debt crisis at the end of last year, they just enacted 2 times 25 basis points. I guess the real difference here is that the recent inflation numbers surprised so much on the downside that they allowed them quite some scope to adjust to that new reality, and they've taken quite a bold step, you'd have to say, by cutting 50 basis points now. That was not expected in the market, even though there was a little bit of a chance priced in. But it certainly feels that they want to try and get ahead of the curve based on better inflation outlook, and also the fact that there is structural change going on in the economy, and the growth figures have surprised a little bit on the downside. So they had scope to move, and they've certainly taken that opportunity.
Tony, does this put them ahead of the curve? Because beforehand you were expecting further rate cuts in May and June. Does that change your assessment?
Well, I suppose doing a full 50 now, and as I said, as guidance last year, just going in gradual steps, considering how low rates are, probably has come as a little bit of a surprise to us. But we thought 50 over the next 2 months. It was just a strategy decision. I suppose what's interesting now, trying to pass through the statement here, is to get some guidance going forward. Clearly, they wanted to get financial conditions lower, and they've done that. There's no real guidance on what happens from here. I guess we are expecting inflation to remain pretty low, so we'll reassess the outlook, and maybe there is some scope for some further modest easing from here. The market's already priced another sort of 50 basis points of cuts anyway over the course of the year. There's nothing in here, I think, that's going to change the market expectations around that.
Does this change the market expectations for the Aussie dollar's trajectory, though? As we know, it's risen by 44% in the last 3 years against the US dollar. Are those gains coming to an end?
Well, it's interesting, isn't it, that there's been a lot of structural drivers keeping the Aussie dollar higher. We've seen ongoing structural reserve diversification in the Aussie dollar. Growth here still remains pretty positive, and you'll still have quite a positive rate differential in the Aussie's favour. And of course, lower rates here is going to improve the growth outlook. I'd expect the Aussie to find some support after, obviously, an initial reaction to this surprise move today. Interest rate differentials still work for the Aussie, so it's difficult to stay short for too long.
What about the housing market? How much of a lift to the housing market, Tony, is this going to give? Because we had a report today, of course, showing that house prices fell for a 5th straight quarter. Has the outlook now improved because of the size of this cut?
Yeah, this is going to be really interesting to see how, I suppose, investors in housing respond to this. They're obviously going to, there's an improvement in terms of household income overall. There's a bigger question in terms of how much further there'll be deleveraging, so how much households might save from this. But there's certainly, at the margin, you'd have to say this is going to be positive for the housing sector. There's still at least some sort of underlying pent-up demand in the housing sector. It's going to feed through to households. It's just a question of how much they save and delever from here.
Tony, how do we make money from this? So give us some rates trading ideas in light of this decision.
Well, clearly now I think that we're going to see a bit more of a rally in the mid-months of this year, but I think later, looking at toward the end of this year, this early move in terms of interest rates maybe means that the market starts to overshoot a little bit toward the end of the year. They've moved early and aggressively, so maybe buying some of the futures in the middle of the year for further rate cuts then, but maybe selling some futures later on in the year. And I think also our bond market, our 3-year bonds have hit a new record high. Their discounting rates going well below 3. Maybe we'll start to see that rally start to fade now.
Tony, thanks a lot. Tony Morris there, head of interest rate research at ANZ Bank. Thanks for your time today, Tony.